watching Business Today Television. I'm Sakshi Batra, and this is our special edition where we are speaking to the top market voices of the country to talk to them about what to expect from the big bang upcoming budget of 2026 that happens on this Sunday. And joining in on this special edition with me is again a very well-known market expert, Mr. Rahul Arora, but for the first time joining in as the CEO of Ashika Institutional Equities on Business Today Television. Warm welcome to you, Rahul. Good to have you with us, and many congratulations on your new role.
It's really appreciated, and it's a pleasure being on your show.
It's always a pleasure to speak to you, Rahul. So tell us, apart from the new things that are flowing into your life, how is the market really looking in this new year? We were thinking that at least in 2025, we'll bury the past and the ghosts of the past with the global external shocks, but seems like, they're just tagging along in the new year as well. And we are heading into the budget with a tad bit of nervousness.
So I think, Sakshi, if we take a step back, I think geopolitics has become the central theme for global markets right now. I think if you take a look at Trump 1.0 versus Trump 2.0, the one major difference is that in Trump 1.0, he had the Senate but not the House. And this time he has the Senate and the House, and which is why he's being able to push through a lot of things that to the large part of the world appear pretty brazen. You do have the midterm elections in the US coming up later this year in November, but that means the next 10 months could be relatively turbulent. If he lands up losing the House in the midterm elections, I think some amount of sanity would return to the markets, as we head into the next calendar year. But I think this is going to be a fairly tricky year for global markets. Add to that, I think your question on the Indian stock markets as we enter. So there are two ways to look at this, Sakshi. I think what drives markets is mainly liquidity. One is domestic liquidity, the other is foreign liquidity. Now, let's say if you're looking at about a 12-13% kind of earnings growth for the fiscal year starting in a couple of months, that is FY27, and I'm a foreign investor investing in the Indian stock market for say about a 12% kind of return, which is a little more than nominal GDP growth, I'm straight away knocking off 3-4% because of currency depreciation. So that 12% optically comes down to about 8-9%. Then you're paying the 12.5% long-term capital gains, and you're adjusting for the inflation that's in your hometown. So effectively, you're left with what, like 5.5-6%, maybe if you're lucky, after adjusting all this on a net basis. When I can buy the US T-bill, which is a fairly safe T-bill to be invested in at about 4.5%, what's my added incentive to invest in a market like India for about 1-1.5%? So I think that's what's causing the FI pressure and outflows. Even from the domestic side, actually, I think, if you look at the spate of IPOs that have come in over the last 2-3 years, that has certainly helped, or rather put a cap on the liquidity that's come into the secondary markets. And I think what's not helped the equity markets over the last year and a half is the way gold and silver has done. None of our moms and dads ever sat us down and said, invest in gold and silver. But as Indians, we traditionally have a bent to invest in real estate, gold and silver, any which ways. And I think the way they have done, that's also put a little bit of pressure. So I think to sum up in one sentence, I think this is a year where you will have to be cautious. You will get money-making ideas, but you will have to be very nimble. But I think broadly, the Nifty could be range-bound in a range of, say, about 24,000 to about 27,000-28,000.
Fair point. Now let's come to the upcoming union budget. What do you think the government should do in the upcoming budget? How to use this opportunity to probably improve investor confidence? Should there be more action onto protecting the Indian economy from the global shocks, or should there be consistent, continued effort on enhancing the long-term growth?
So I think there are two aspects here, Sakshi. I think the government is walking a very tightrope when it comes to finances. So I think if you look at the fiscal deficit for this current fiscal year, it's probably going to end up around 4.4%. I don't think she will project more than 4.2% for next year. The reason for that is that indirect taxes have seen a dip in collections post the GST cuts. Income tax and corporate tax is all right, but I think we're probably looking at tax collections for FY27 to be, say, about between 9 and 10%. GDP growth to be somewhere around 6.8 to 7%, add about 3.5% inflation to that. So you're looking at something like about a 10.5% nominal GDP growth. So I think when you're in this growth environment where your tax collections are a bit constrained, I think the government will have to watch the expenditure side very closely. I think you'll probably look at a situation where capex growth will probably be around 9-10%, is my sense, at best about 10.5%, in line with nominal GDP growth. Within that, I think if you look at the two major sort of legs, which is roads and railways, I think the spending there also could be in that range of about, say, 9 to 10, 11%. But I think the focus, and I think we got a hint of that in the recent FTA announcements as well by the European Union and India. I think if you look at the defense spending this year, which has gone up, I think, 45, 50, 55% maybe, that number could be slightly north of that in the next couple of months. But I think on that base, you'll probably see that defense spending growth would probably be pegged at, say, about, anywhere between 15 to 25%. So I think that will sort of be where the focus is. But I think if, as normal tax-paying citizens of this country, I think if you're expecting anything on personal income tax, that will be a little far-fetched. I think she's done what she could in the last budget. I don't think she has too much room to maneuver on that front. But yeah, I think PLI schemes might get extended. I think sectors that are directly in the line of fire as far as tariffs are concerned, may see subventions and subsidies coming through for them. But it's going to be a tough and tight rope to watch. I think the focus now, Sakshi, may shift from the obsession of fiscal deficit to debt to GDP, which is currently about 55% in India. And we think that will probably head to about 50% by FY30 plus minus 1%. So I think everything will probably move into that direction of, say, maybe by FY30 to take the debt to GDP ratio below 50%, and probably maybe another 50-75 basis points reduction on the fiscal deficit side.
Fair point. You did talk about the defense space, and I wanted to prod a little bit more because there's a heightened retail investors' interest in this space. India has already recorded highest ever defense production at 1.5 lakh crore rupees in FY25. And now even global brokerage houses, say Morgan Stanley, is believing that this sector can clock in about 12 to 15% growth going forward. Now in the current budget, we did see, in the FY26, budget, defense capital expenditure grew by about 13%. So are you saying on top of that, is there possibility that we see an additional 20% jump in the budgeted defense capex?
Absolutely. I think that's the number. Like I said, I think anywhere between 15 to 25% is a reasonable number to expect on the defense capex growth.
Okay, and which are the key sectors apart from defense that should be in limelight post the budget, and how should investors be maneuvering those sectors now?
So I think, Sakshi, the onus is going to be to try and keep consumption moving as much as you can, because I think with the global tariff wars, I think, so if you look at the formula for GDP calculation, slightly theoretical, to digress a bit, but it's C plus I plus G plus X minus N. So consumption plus investment plus government spending plus exports minus imports. Now the X and M is really not in your control because of what's happening globally, right? I think with tariffs and FTAs and things like that. So the focus comes on C, I, and G, which is consumption, investment, and government expenditure. And typically in India, if you see, for the last 25 years that I've been in the capital markets, I tends to lag G. So when the government spends, then the private sector sort of comes in. So I think if you deconstruct it that way, I think the onus for the GDP growth will lie first on government spending, and second is to keep consumption sort of booming in India. I think the GST cuts are certainly going to help. I do believe that the income tax exemptions that she gave in the last budget are not one time. They are definitely structural in nature, because it's obviously altered, the taxation structure for everyone in the country going forward on the new tax regime. So I think from a sectoral standpoint, one is of course defense. I think the other would probably be consumer, but within consumer, Sakshi, I'd say more consumer discretionary as opposed to consumer staples. I also think that there is a situation where credit growth has probably bottomed out. I think we had gone into single digits as far as credit growth is concerned. So when capex picks up, obviously, people are going to come in and look at, mobilizing more funds in the system. So it is very possible that as you enter FY27, the credit growth that had dipped into, the high single digits, 8-9%, that probably inches up closer to 13-14%. And then the banks benefit in a very material way. I think you remember, Sakshi, in the last super cycle that we had in the banking sector, names like HDFC Bank, Kotak Mahindra Bank, these have all traded at, Bajaj Finance, these have all traded anywhere about 4-5 times price to book. Bajaj even 6-7 times or higher. So we're nowhere close to that. I think the most expensive, largest private sector bank today must be trading at about 2.6, 2.8, somewhere in that range, maybe 2.9 times. So there is a headroom there as well. So I think entering this fiscal year, even from a budget standpoint and beyond, I think banks, consumer, discretionary and defense would be my three sort of picks as far as sectors are concerned.
Fantastic. The one missing factor that we've been addressing all through, the previous calendar year is the constant pulling out of money from the FII. What is it that can bring back the FII money? Can the budget, enhance that aspect in any way? Okay, can you hear me now? Are you able to hear me now? Okay, maybe we'll try and connect again, and we will see how Rahul can maybe come back, and maybe that line gets through. But clearly, as Rahul has pointed out, that the capex push is going to be pretty strong. Defense outlay could actually see 15 to 25% kind of a growth on top of the growing defense capex that we've been seeing over the last couple of years. Infrastructure could well be in focus as well. Rahul, are you back? Can you hear me now?
Yes, loud and clear, Sakshi.
Fantastic.
The word of technology.
Yes, absolutely. I wanted to ask you, the absence of FII, do you think the union budget can address that in any fashion? We have seen, like you pointed out, several reforms that have been undertaken by the government in the previous calendar year by various taxation reforms, indirect, direct, even the tax code for that instance. So simplifying has been the key focus. Despite that, the FIIs have been pulling out money. First up, help us understand why is that happening. Is that more to do with India, or is that more to do with chasing better opportunities outside? Two, what can the budget do to bring back FII money sustainably and consistently?
So I think, Sakshi, the first part is what we've discussed in my first answer, where you have safe options, right? Like I said, you have about a 4.5% US T-bill, which is a relatively safe asset. And like we were discussing, if you adjust for hometown, like your home country inflation, the taxes you have to pay in India and the rupee depreciation, there is not too much of an arbitrage or an incentive for FIs to be investing in India at this point in time, especially if they believe that the market returns are going to track earnings growth, which, as we said, could be in the range of 12-13%. Obviously, this changes the entire outlook changes if the person believes that he's going to get 20% plus in the Indian capital markets. Then the numbers start to make sense. But for 20% earnings growth for 20% capital market returns to happen from an index, you would need earnings to be somewhere in that 18-20% kind of range. And I don't think that, from a headline index perspective, is something that we're gunning for in the coming fiscal year in FY27. Add to that the points that we were making about global commodities. We spoke about gold and silver, but I think if you look at most other global commodities, they're booming. China is reviving itself in some fashion, and even when you're talking about themes globally going forward, you're talking about AI, you're talking about robotics, you're talking about EVs, data centers. These are all sectors that are going to require very heavy investments in specialized chemicals, rare earths, silver, so on and so forth. So I think alternate asset classes that have emerged, and also the fact that India as on a post-tax, post-inflation, post-rupee depreciation, with a 12-13% kind of return doesn't look that attractive. So I think what can the budget do? If there is some relief on taxation for foreign investors, which again I don't think is very plausible, that would certainly help. As far as domestics are concerned, Sakshi, like I said, again, gold and silver has a very big role to play in the fact that equity markets have not boomed. So let's look at it let's just look at it very simplistically, right? So today, if I'm investing in a fixed deposit, I'm getting 7%. Right, most of India would be around that 20%. The middle class would be around that 20% tax. So you're talking about 5.6% post-tax on a fixed deposit, right? So if I'm sort of getting 12%, returns in the Indian capital market, and my inflation is 3-4%, you're still down to about 8-9%. You're still paying 12.5% long-term capital gains tax. That number still comes down to about 6.5-7%. So then you say, कि भाई अगर मेरे को FD में 5.5-6% ऐसे ही मिल रहा है for about 7-7.5%, is it worth taking the risk for a couple of percentage points? So I think that's the challenge that the stock market is facing right now. inflation, rupee depreciation, other alternate asset classes, and just the fact that earnings growth hasn't, we are still not in that 15-20% kind of earnings growth. So I think all these things need to come together for the Nifty to potentially make a serious dart towards 28-30,000. But for the immediate short term, I think if she's able to do something on the taxation for the FIs, then don't be surprised that the Nifty could be up even 500,000 points on the day of the budget. But I think the probability of that is very low.
Yeah, the probability is the key question there. Apart from this, like you pointed out on gold and silver and these precious metals, this rally has surprised and almost shocked everyone who was tracking this very closely, who has been probably looking at silver and gold very, very intricately over the last many decades. Nobody could have imagined what has really happened over the last couple of months in both gold and silver, especially silver, how it has rallied, beyond everybody's imaginations. Of course, it's created a lot of FOMO among retail investors, and they are now at the top of this peak already, looking at, okay, now I should have a sizable exposure to my investment portfolio when it comes to gold and silver. And of course, from last couple of years, we have been seeing the underperformance in the equities that is even forming their thought process there. How would you advise that retail investor to look at gold and silver right now?
So on a lighter note, Sakshi, I think if you go to any building society and you go down and watch these aunties that gather at about 6:37 for their walks or for a little bit of gossip, and you tell them कि gold silver यहाँ चला गया, क्या पता था, they turn around and say हमने तो कहा था. So they, that's a different word altogether, where you do have a section of people who have, sort of grown up investing in these asset classes and always believe that it will go up. But on a serious note, Sakshi, I don't have the courage or guts to sit here and tell somebody to buy gold or silver today. With the kind of returns that they have had, honestly, it's like buying a stock, right? Let's say it's a 100 rupee stock and the stock becomes 200, 250. You're obviously a little cagey in terms of investing because you don't know what kind of incremental returns you'll get. But in the same breath, Sakshi, I'd like to say that if you have it, I don't see any compelling reason to sell it. So that may be, one advice that I could give, that if you have it, there is no compelling reason to sell it. But if you're entering it right now with silver north of 4 lakh rupees, gold doing what it is, I don't know what kind of returns you can expect. Obviously, if the world remains in a very uncertain environment for the next 8-10 months, as we were discussing a little earlier, till the US midterms, could you have a situation where silver goes to 5 lakhs and beyond, gold gives up, gold goes up another 40-50%? Sure can. But am I an expert to say that this can definitely happen from here? I don't know. So if I was holding on to these assets into the form of an ETF or physical or whatever, I would not sell them. I would keep it. I think. Okay, so let me give it to you in a slightly different way, Sakshi. I think if I was, let's say, a single working professional with, only myself to look after, I would still say that you would probably have about 60-65% of your investments in equities, but you should certainly look at having anywhere between 30-40% in alternate investment classes right now. I think as much as sector diversification or stock diversification is important from a stock market perspective, I think what the last couple of years have taught us is what is equally important is portfolio diversification, and I think that is more important today than I have seen in the last many, many years.
Wow, okay, got that. So I think it's all about asset allocation and comes down to that. In case you don't have any investment there, then it's probably important for you to look at the asset allocation bit and probably decide for yourself. But at these all-time high levels, it still is very difficult to give that advice, even if you see another 20,000 rupee jump up tomorrow on silver yet again, as we have been seeing on an everyday basis as well. Okay, let's also talk about are there still any, red flags or sectors that you'd like to stay away, or places you'd like to stay away, despite the, consolidation that has been at play, despite the fact that some of the pockets have become probably more attractive than the others? Are there still any pockets that you would not touch?
So I wouldn't want to be, as negative as saying not touch, but yeah, I think if you were sort of asking me in the pecking order, I think my least preferred right now, just in terms of growth, would be frontline IT and frontline consumer staples. And I think if you look at frontline IT, whether it's TCS, Infy, Wipro, HCL Tech, or you look at the levers of the world, I don't think that you're in a situation where you're going to have double-digit top-line growth sustainably. In consumer, in some pockets that is emerging, but I don't think that is marrying with valuations completely at this point in time. So I think these are two I would be a little circumspect on. If I was to start nibbling between these two, my preference would still be more towards consumer staples than IT, but I don't think there is a pressing need to buy either of these right now. The second space, which I think we could probably avoid for a little bit, but I think maybe the time to buy it maybe a month or two from now, could be the entire consumer durables and electrical space. They've had a tough period coming into this result season as well. In some parts of India, in the parts where you're sitting, winter has been very severe. Unfortunately, in Bombay, we don't get winter, so we don't know what that looks like. But, I think AC sales and so on and so forth, you're seeing that in the results of Blue Star, Voltas, and some of the other companies as well. Even Dixon Technologies has had a negative return year. We've loved these companies in the past. We continue to be structurally very positive. But I think these are pockets that, can wait a little bit more. I think durables and electricals, we will start nibbling in once we have some clarity on how summer is going to be and how inventories are in a couple of months from now. And then I think, as we get closer to the monsoon projection, I think consumer staples could be nibbled into. And bottom, like sort of in that pecking order, the least preferred at right now would be frontline IT companies, where I think that the growth rate would probably be more like between 8-10%. And the valuations are still trading, anywhere between 18 to 22 times on a 1 year forward. So these are three I'd be a little circumspect right now, but some of these, like I said, at various intervals start becoming a little attractive.
Okay, we'll keep an eye out on that and keep chasing you to understand when is that opportunity to nibble in there as well. What about the broader markets, the mid and small caps that are thus far underperformed the large caps? Do you think 2026 is giving any signals that this pocket could also come back?
So I think, Sakshi, what the last 12 to 15 months have taught us, and very thankfully so, is stop asking that question on the streets to any random person, give me a multi-bagger idea. I think that is done. So those conversations have receded to a very large extent. Somebody once told me, once your gym trainer starts recommending stocks to you, the market is sort of, topped out. But I think it's been a very welcome correction, Sakshi. I think most mid caps and small caps was trading at more than 2x the valuations of their large cap peers, which was practically unsustainable. I do understand that the earnings growth has been better for them, but I think the valuations that they were commanding were very excessive. Some rationality has certainly returned. But I think there is a case if you do get a lot of these flavored mid-cap stocks that, some which we have discussed, if I get them another 15-20% cheaper, I'd be far more comfortable. So I think they're in the process of bottoming out. They could potentially bottom out in the next week, 10 days or a month. But I think that they will certainly outperform the large caps. I have no doubt about that in the calendar year 2026. But you will have to be very stock specific. Like what I mean is, don't say that, okay, I'm going to buy mid-cap cement and go buy the whole basket, or I'm going to buy mid-cap IT and buy the whole basket. You will have to be very bottom up in your stock selection. Like I said, Sakshi, in my opening remarks, that I expect the Nifty to consolidate between 24 to 27, 28,000. That does not mean you're not going to make money. I mean, if the Nifty goes from 25 to 27,000, you're talking about, an 8-10% return on the index. Stocks are going to go up 15, 20, 25%. So there is going to be enough money to be made long and short side, but you need to be very bottom up. And at an aggregate level, I still think the stocks that I'm looking at, if I get there 15, 20% cheaper, great. But if you have a little bit of courage and, you can average on the way down, I think some of the quality names are already at very attractive prices. But as an index, I think the mid and small caps will outperform large caps in 2026.
Okay. Rahul, we've also been seeing this entire big trend that the markets are very positive on, is that how India is striking a lot of FTAs with independent countries and, hoping that probably these FTAs would be able to offset as the impact what we were talking about Trump's tariffs that have been largely keeping the sentiments low. Do you think the stock selection from here on should also be basis what these big bank deals are going to be offering in terms of opportunities over the next couple of years, maybe 3 to 5 years?
It's a slightly long drawn out time frame, Sakshi, because I think by the time this is consummated and this actually comes into effect, it's still going to take a little bit of time. Obviously, eventually some sectors will see an impact. I think alcohol, for example, because the duties on scotch and wines will come down. So how do our domestic listed companies compete with the imported whiskeys and wines? On automobiles, particularly on premium automobiles, when you have duties cut, what happens to people who say wanted to buy a Skoda but then say, okay, I'll wait and maybe buy an Audi, BMW, Mercedes. So there is going to be an impact. There is no question about that. But I think this will happen with a bit of a lag. I think, but conversely, I think defense is one thing that Ursula spoke about in the press conference as well, and she was sounding extremely upbeat in the collaborations with India and the joint military forces and the exercises that they were talking about. So that could be an interesting area to look at. The other could be drugs. I think if the pharma market opens up in a very substantial way, that could be a very interesting space to look at. But I think, like I said, Sakshi, I think this is going to take some time to consummate. But I think the two sectors I will watch out for from a competitive standpoint would be auto and liquor. I think things that we could benefit from would be things like defense and drugs and pharmaceuticals. But yeah, I think in time, I think the movie will sort of reveal itself, I think.
Fantastic. We're running out of time, but I just have time for one more question to you, and that is by way of upcoming budget. What is it that could make or break this budget? Is there a thing that you're watching out for and crossing your fingers for too?
I think make the budget, Sakshi, is if she, I mean, nothing will make it like increasing the income tax exemptions or reducing the income tax rate. I think that itself can take the market into a different orbit. But like I said, the probability of that is very low. Conversely, if any benefits that have been given to the middle class are rolled back, or anything that negative that comes out on the stock market taxation front, that could probably be a negative. But again, if you look at the disinvestment numbers, Sakshi, they've been pretty poor for the last couple of years. So the government of India itself needs a buoyant market to disinvest. I think they have achieved only 20% of their target. If you look at core disinvestment, of course, if you add asset monetization, that number goes up to about 40-45%. But core disinvestment needs a good stock market. So the one chair I don't want to be sitting on going into Sunday is the finance minister's chair. I think she has a very tight rope to walk. But let's see. I think she'll manage to pull off a fine balancing act. But just circling back, because a thought just came into my mind for a sector that's been dead and buried for so many years. I think if you look at Bollywood for the last 6 months or so, it has revived in a very, very, very material way. The kind of collections that we're seeing from a lot of movies, not just Hindi movies, but even regional movies, South.
Correct.
So, PVR Inox as a stock or multiplex as a sector has not been in flavor for a very long time. You never know. This could just be the year where, you're seeing evidences of people getting back to the theaters. The collections for movies like Border and Dhurandhar 2 coming up, and there are so many other big budget movies later this year, Ramayan, etc. So this could be a year when the multiplex sector also does well. We didn't touch on that, but it's just a sector that I believe with that it's been out of flavor for a while, and the pipeline looks good. So this could be a dark horse for this year as well.
Could be a dark horse for the year. So thanks a lot for sharing that insight as well. Thank you so much, Rahul. It's always a pleasure to have you with us. And this Sunday, of course, you'll be celebrating the birthday, as you always do, with the finance minister presenting the budget. So we wish you all the very best for that. Yet again, a Sunday gone in dissecting the fine print of the budget for you. But as far as the Delhi winter is concerned, fag end there. So please do come in and make the most of it if you can. And the pollution levels are also low. So probably the best time for you to come back to Delhi and to see.
Inshallah, very soon, Sakshi. Hopefully, look forward to being there, because you guys have the best food in the country. I think Delhi and Punjab have the best food.
We'd love to take
hopefully
you on
we'll be there
a
soon enough. Looking forward. Thank you so much.
Thank you so much, Rahul. All the very best, and thank you so much for being with us.
Thank you.
Alright viewers, we'll wrap it up on that note on this special edition of the pre-budget conversations. I hope you have really noted down a lot of insights that Rahul really truly made right ahead of the budget. What are the themes that are going to be working in beyond the budget? What should you be really looking at? Multi-asset allocation strategies and everything that you needed to know right here. This is one interview that you should continue to watch over and over to take all those insights that you missed watching by once.